Turnbull government is reportedly considering changes to negative gearing and the capital gains tax as it puts together its housing affordability package for the May budget. The Australian reports the government's consulting with property, housing and community groups and focusing on the supply of housing rather than demand. It's believed it will consider capping the size of negative gearing deductions and cuts to the CGT discount from 50 to 40%. It comes just 1 week after the OECD raised alarm bells on the nation's ballooning household debt. For more, we're joined by Nathan Bell from Peters McGregor, who's live in our Sydney CBD studio. Nathan, good morning to you and thank you so much for joining us. Now, noting, the recent warning from the OECD and our particularly high levels of household debt, what are your thoughts? I mean, if there was a housing downturn, how would you expect the Aussie dollar in particular to perform?
Yeah, well, we're international investors, so this is a big issue for us. And at the moment, we're holding our cash levels in the portfolio. We're unhedged. We're holding the dollars, in the US dollars, and we're unhedged. We're about at the long-term average for the US dollar versus the Australian dollar. But if we had a genuine housing downturn and we saw a big increase in unemployment, I don't see why there's any reason why the Aussie dollar wouldn't fall to below 50 cents. I think somewhere, depending on how bad it was, just plucking numbers out of the air, maybe in the mid-40s or low 40 cents even, at that point I'm pretty sure that we'd see overseas investors, big European pension funds and the like, who have huge amounts of money they need to invest. I expect, given that Australia is a pretty safe place to invest your money, particularly in our part of the world where you've got China and a lot of Asian countries who have experienced massive currency volatility in the past, I think once you get into the 40s, the Australian dollar would find support. But that's a long, long way from where we are at the moment. So if the numbers are still correct, I believe 1 to 2% of self-managed super funds have their assets in overseas investments. They still look pretty short to me, given the risks.
Where in particular, when we talk about the Aussie dollar and then the subsequent reaction if there was a downturn, what about for investors looking at equities? How would you position a portfolio in anticipation of such an event?
Yeah, look, it's really difficult, and I think this is why we just focus on individual businesses rather than trying to predict big macro events, because it is so difficult. Not only do you have to get the situation right, but you have to know when it's going to happen, and that's really the difficulty. And I think the problem Australian investors have at the moment is the really good high-quality companies that, like a CSL or a Cochlear, which the general pace of growth in the economy doesn't matter too much. They're really highly valued with PE multiples in the 30s. And then if you look at some of the more cyclical stuff, which like maybe Nick Scali, you've seen really benefited from people fitting out their new houses and redeveloped homes with couches and so forth. So I don't really feel like there's anywhere for investors to hide from this. What I think is the most smart thing you can do is actually consider international investment. Obviously, I'm talking my own book here, but personally and in our fund, we're very heavily invested overseas because that's where we're seeing the value. European banks now look like the US banks a couple of years ago. It's a really hated sector, but it's a sector which has already had a huge housing bust to deal with and lots of problems in the economy, and now they're starting to improve.
Speaking of US banks and investing around the globe, I mean, you've been investing in banks around the world since the GFC, and we've often spoken to you on this. Where do you think the best value is currently?
Yeah, so we had a lot of investments in the US coming out of the GFC. That's not where the real value is at the moment in the last 12 months, or particularly since Trump's come in as president. Everyone's got much more excited about the US economy, much more excited about higher interest rates and a higher inflationary environment. And that would work very well for the banks. So you've seen just Bank of America, which we don't own anymore, but that went from $11 to $25 in 12 months. That's about $65 or $70 billion in market value created. So I'd say the market had it wrong at 11, but it's probably fair price around 25, if not a bit lower. But the value for us at the moment is the European banks. Previously, I thought it was a place that was probably too risky to invest, but we've seen Deutsche Bank looking to raise a rights issue of €8 billion, and UniCredit, which is a large Italian bank, which is a big problem area, they did a rights offering for €13.5 billion not long ago. So this tells me that the banking sector is becoming much, much safer. We've invested in ING Group, which I'm sure you've seen the ads for. It's a very good business. It doesn't have any of the legacy issues from the GFC. It's actually sold a lot of businesses and got rid of a lot of the problem loans. So it's really quite a clean bank, and it's just really a growth story. We don't expect to make double our money or anything, but I think over the next 2 or 3 years, there's 15+% returns from the dividend and just doing the ordinary things that this bank does.
All right, fantastic. Nathan, great to have you on as always. Thank you so much for joining us.
Thanks, Leanne.